Are you thinking of living abroad and wondering how to build or preserve your wealth while navigating complex international tax rules? This video tackles the biggest investment challenges facing UK expats, from choosing the right investment accounts to avoiding costly tax traps. We'll explore practical strategies that can help you grow your money efficiently no matter where in the world you call home. This video is sponsored by Wise, and if you use the link in the description, you'll get a free first transfer of up to £500 if you're a new Wise customer. An expat or expatriate is someone who chooses to leave their native country and live abroad, and that could be on a temporary basis or it could be a permanent move. And there are lots of reasons why people may choose to do this. It could be a work placement. Your boss suddenly says, fancy living in Singapore for the next 3 years? Or it could be where you choose to retire. Many people choose to study abroad, or it might be for tax reasons. I've spoken to an increasing number of people who are digital nomads. They wander the world based on wherever their fancy takes them. And they have jobs which they've created, kind of like mine, where you're not tied to a particular country. And then finally, you may choose to move abroad temporarily to spend time with family who've made that move as well. Whatever the reason, in this video, we'll look at how to do that efficiently as an investor. Now, the first risk people usually come up with when moving abroad is currency risk. So let's say you're on a work placement and you're paid in US dollars. If the local currency strengthens versus the US dollar, well, effectively you're earning less money. So that currency risk applies if you're earning in a foreign currency and then converting that to your local currency. And over the short term, some currencies can be very volatile, particularly emerging market currencies. Here you can see a table of volatilities for various currencies versus the US dollar. Notice the currencies at the top tend to be those emerging market currencies, like the Brazilian real, the Turkish lira, and then at the bottom you've got developed market currencies, which tend to be less volatile. Some currencies are pegged to the dollar, some are managed, so their volatility is low. So for example, the Chinese renminbi, which is at the bottom of the table, is managed within a band relative to a basket of other currencies. So this is something you should be aware of if you are going to be earning in a currency which is different to the currency which you're spending day to day. Now, there's not a lot you can do to mitigate that risk. If you are being placed into a job in Europe, for example, you could insist on being paid in euros. But if you did want to see the grouping of currencies according to whether they're emerging market or developed, that's what this tree tells you. Currencies which are close together in the leaves of the tree are highly correlated. And you can see that there's very clear clustering here. So for example, for the developed market currencies, they tend to cluster together. Emerging market Latin American currencies, again, cluster together. And those safe haven currencies, the Swiss franc, the Japanese yen, also cluster together. So just be sure you understand the risks of the currency which you could be taking on board. Now, what's certainly true is that over the long term, currency matters much less than investment returns in equity. Here I've compared the S&P 500 over the period from 1970 up to 2025, and I've shown it denominated in sterling and in native US dollars. Now, over this period, in the bottom panel, you can see that sterling's been weakening versus the dollar, and that's given the US stock market, expressed in pounds, a big leg up. If sterling strengthens versus the dollar, things would go in the opposite direction. Now, if you are going to be investing over the long term, I wouldn't worry too much about currency fluctuations, because the drift from equity markets tends to drown out the movement from currencies. The longer the period of time you look at, the greater that dominance of drift. But if you are going to be investing over the short term, and you'll need that money over the short term, then currency is a real risk. And there you may want to think about investing in your local currency, whatever that is. So let's say you were based in the Eurozone, you might want to invest in euro-denominated funds. So some domestic allocation would probably make sense to mitigate that currency risk. But of course that depends on the country that you're based in. If it is an emerging market, then the local equity market may itself be very volatile. So these are the kind of considerations you'd have to think about. How volatile is your currency, and how volatile is your local stock market? And is it worth having a currency hedge so at least you're not taking the FX risk? Now, before we go on to talk about the ins and outs of expat investing, let me introduce the sponsor of today's video, which is Wise. I first came across Wise when I transferred money internationally for my business, and I was amazed at how much better their rates were compared to banks or other transfer services. For investors, currency conversion costs can add up fast. And that's true whether you're drawing an overseas pension, selling foreign shares or ETFs, or receiving dividends in another currency. Wise can save you a substantial amount. The bigger and more frequent your transfers, the more you keep. With Wise, you get local account details in 9 currencies, including the US dollar, the euro, the Aussie dollar, the Canadian dollar, and sterling. That means providers such as your US 401k, UK or EU pension scheme, and even international brokers can pay you as if you're a local customer. You can then convert to pounds at Wise's mid-market exchange rate with no hidden bank fees. If you sell US listed ETFs, collect foreign dividends, or take profits from overseas property or private investments, you can receive the proceeds in that currency directly into your Wise account and then convert only when it suits you, quickly, cheaply, and with a clear upfront fee. Wise makes cross-border investing and income transfers simple, transparent, and low cost. And you can use the link in the description for a fee-free transfer of up to £500, and that's exclusively for PensionCraft viewers. Now, if you hold accounts with UK platforms, when you move abroad, you may find that there are new restrictions. Now, no two platforms are exactly the same, unfortunately, so I can't show you something which is general. But as an example, here's what Vanguard UK does. Now, if you've got a UK ISA, an individual savings account, or a general investment account with Vanguard, they give you 3 options if you move abroad. You can either sell your funds, withdraw the cash and close your account, or you can keep your account with restricted access, or you can transfer to another provider who supports overseas residents. Now, what is kind of surprising is that if you move to the US, and remember Vanguard is a US company, at least the parent company is, your only choice is to transfer to another provider or to close your account. Possibly that's because of the rather draconian tax rules in the United States when you move there. So that was the ISA and the general investment account. If you have a SIP, when you retire, as long as you have a UK bank account, they can help you withdraw cash into that. However, they're not willing to do transfers to ROPs, and we'll come on to that in a minute. So that's the case for Vanguard, and many other platforms are quite similar, but you've got to do the research to find out how your platform deals with you once you move to another country. But I think one of the greatest difficulties for expats is the complexity of tax. Now, a bit of nomenclature will help here, and I think it's really important to understand the difference between domicile and residency. Domicile is quite a complex legal definition because it's essentially saying where your permanent home is. Now, if you've got multiple homes, that could be quite difficult to define, whereas residency is more straightforward. Where did you spend most of your time physically? Now, in the UK, the rules around inheritance tax for expats have become much simpler, I think, because it's moved from this domicile definition to this residency definition. So if you have been resident outside the UK for 10 or more years, then you're not liable for UK inheritance tax on things which you sell and assets which you own outside the UK. For the other 2 types of tax which you'd have to think about when it comes to investment, those are income tax and capital gains tax. Well, income tax is fairly straightforward because again, that's residence based. If you're living abroad, the only income which is going to be taxed by UK authorities, by HMRC, will be UK source income. So let's say you've kept a buy-to-let property in the UK, then even if you move abroad, you're going to have to pay tax on that UK income. If you've moved abroad and you're earning income, say working for a company abroad, then you're not going to have to pay income tax on that income in the UK. For capital gains tax, there is a slight complexity. Now, what UK tax authorities were trying to avoid was somebody buying a stock in the UK, moving abroad to their house in Monaco maybe for a year, and then selling it and not paying capital gains tax. So to avoid that, there's a 5-year rule. HMRC can claw back the capital gains tax if you haven't been living abroad for more than 5 years. So let's take that example of a share which you bought when you were living in the UK. You move abroad for 3 years, you come back to the UK having sold it for a profit, well, you'll still have to pay capital gains tax. If you'd have stayed abroad for 5 years or more, then you wouldn't have had to pay that capital gains tax. Now, if it's UK property that you're selling, well, there you will still have to pay tax, capital gains tax, if you sell that UK property for a profit. And that's even if you're an expat who's lived away for more than 5 years. And since April 2019, that rule on UK property sales has been expanded to include any UK property-rich companies. So those are defined as companies where at least 75% of the value of the company comes from UK land. It could be UK forestry, for example, as well as UK commercial property or residential property. So really, I'm just scratching the surface here. You can see the complexity of the rules. Not only does it depend on UK tax rules, it also depends on where you move to. Now, the worst of all possible worlds would be if you have to pay tax twice, both in the UK and in the country in which you're living. So it may be worthwhile looking to see whether there's a double taxation treaty between the UK and the country where you're resident. If that's the case, then it can be a big benefit to you. Now, given the complexity of all these rules, particularly to do with tax, you might be thinking, well, I'll just pay an advisor to help me. But I speak to a lot of clients one-to-one, and what they tell me is that in certain places, it really is the Wild West when it comes to advice. And that's true particularly in Asia and in the Middle East. So what I think might be useful here is to have a set of red flags that we can work through to figure out if your advisor is a cowboy. The first thing to check for is whether the advisor's telling you, I'm a genius that can pick stocks and I can beat the market because I'm really good at that. The fact is, if they were great at choosing stocks, they wouldn't be working as a financial advisor. And if they think they're good at choosing stocks which can consistently beat the market, that reflects a rather shocking lack of self-knowledge. There's a huge amount of evidence that shows that even professional fund managers struggle to beat the market. And I'd go even further. Another red flag for me would be if they say they can find an active fund manager who can consistently beat the market. Many UK advisors are coming round to the idea that passive funds are usually the best choice for most UK investors. The myth that you can have amazing fund managers who can trounce the broad market is not one that's very pervasive any longer. And yet I have heard many stories about advisors saying exactly that in these other regions. Another thing to watch out for is their all-in fee. Now that would include the platform cost, where you hold your investments, and it would also include things like trading costs, advice costs. If all of that added up comes to more than 1% per year, you're probably paying too much. And if the fees are very difficult to find on their website, or if you ask them about fees if they're a little bit cagey, well, again, that's a huge red flag. If they're trying to sell you really complex financial products, particularly structured products, again, you should really question whether they're acting in your best interests. If you don't understand the products, you should never buy it, even with the advice of an advisor. So if you are worried about the quality of the advisors wherever you've moved to, then maybe find an advisor in the UK who's also qualified to advise on the region you've moved to. They do exist, although they are quite difficult to find. Now let's turn briefly to retirement abroad. Now what's good about this is that you usually have the choice about where you're moving to. So in other words, you have much more control over where you end up. If it's to do with work, usually that'll be a restricted choice. So just think what really is going to suit you and what's important to you. Is it climate? is healthcare and the quality of healthcare and the cost of healthcare going to be very important to you as you age? What kind of living costs are there in the place you're moving to? And something which many people don't consider, not just the living costs today, but the rate of inflation in that country. If it's quite reasonable today, but the rate of inflation is above 50%, well, that's not going to be sustainable. Plus, another consideration was whether you feel safe in that country. What are the statistics for scams for older people in that country? All of these are things you should research. And of course, what are the tax treatments? Is there a double taxation treaty with that country? Will you keep your pension triple lock? Which, as we'll see, is not the case in many countries. Now, some people have chosen to move their UK pension scheme into a foreign pension scheme. And in order to do that without paying a punitive tax penalty, it has to be a specific type of foreign pension scheme, which is synchronized with UK legislation around pensions. So this is called a Recognised Overseas Pension Scheme, or ROPS. Now, a lot of people still use the old term for this, which is QROPS, and that's a Qualified Recognised Overseas Pension Scheme. How can you tell whether a scheme falls into this classification of being ROPS? Well, there is a website from the HMRC which lists all of the schemes. So here is that list, and it's a very long list, and it's broken down by country. And rather disconcertingly, HMRC says they cannot guarantee these are ROPS or that any transfers to them will be free of UK tax. Well, that would have been quite useful, but it turns out that it's still your responsibility to find out if you have to pay tax on any transfer of pension savings. If it turns out that it's not ROPS, then you will be facing some fairly stiff penalties, so this is really worth researching. But the list is very long, lots of Australian funds here, so at least that'll help you with your research. But unfortunately, that list will not give you a conclusive answer. So what are the attributes of a ROPS scheme which make it ROPS? Well, it has to be established in a country with appropriate regulation of pension schemes, and those schemes have to be recognised by the local tax system as a pension and not just a savings or investment account. The treatment of non-residents shouldn't be more favourable than residents in that country, so there shouldn't be any kind of special perks for expats. And of course, being a pension, there shouldn't be any early access to your money before the age of, say, 57, unless of course you suffer a severe illness. But the most important attribute, I'd say, is that the scheme has to agree to report back to HMRC for at least 10 years after the UK pension transfer. And that's so that HMRC can check that the fund is compliant. How about your UK state pension? Well, of course, that'll be paid out to you wherever you live based on what you're entitled to. And that can be paid into any bank account you choose. The only requirement is that it has two numbers. You'll need your bank's international bank account number, or IBAN, and you'll need the bank identification code, or BIC. It will be paid in the local currency, so if that currency strengthens versus sterling, that means you'll get paid less money. So that is a risk, of course. Another risk, which many people don't realise, is the triple lock. Now, as I make this video in 2025, we still have this very generous linking of UK pension growth, for the state pension at least, such that it'll always rise by the greatest of average earnings growth in the UK, CPI inflation in the UK, and a guaranteed 2.5%. Whichever of those is largest is what the annual growth of your pension will be. Now, you might think that would carry over to wherever you live, but that's actually not the case. The vast majority of UK expats live in a country where their pension's amount is frozen at the same rate it was when they first became entitled to it, or the date they left the UK, if they're already pensioners. And that's because 84% of people claiming their UK pension who live abroad live in Australia, Canada, or New Zealand, all of which don't carry over the triple lock. They'll get one of these frozen pensions. Now, if you do live for a considerable period of time, that uplift from the triple lock can be considerable. So which countries do carry over that triple lock? Well, any EU country, so France and Germany, for example, but also countries like Switzerland, Barbados, Bermuda, Guernsey, the Isle of Man. Israel, Jamaica, Jersey, Mauritius, Montenegro, North Macedonia, the Philippines, Serbia, Turkey, and the US of A. And not forgetting, of course, Bosnia-Herzegovina. So in conclusion then, bear in mind that none of this is tax advice. I'm not a tax expert by any means, and it's not investment advice either. But it pays to research these things before you move. Otherwise, as you can see, you could end up with some real gotchas. And certain aspects of investment apply wherever you live. For example, keeping your investments simple, keeping your fees low, diversifying, choosing a portfolio that matches your risk capacity, your risk appetite, your investment horizon, and of course all of the mathematics behind sequencing risk. That really sensitive period a few years before and after you retire when you do want to de-risk a little bit. But hopefully this has given you ideas about how to start your own research if you're considering becoming an expat. Now don't forget the offer from the sponsor of today's video, which is Wise. If you use the link in the description, you can claim a fee-free transfer of up to £500, and that's exclusively for PensionCraft viewers. And, as always, thank you for listening.